Hello everyone, welcome to CDH Cross-Border Family Channel. My name is Ko Fujimoto. I'm a principal of CDH PCA. Today I'm going to talk about the second part of US exit tax, the basics of US exit tax. So please enjoy our video. Okay, so in this video, I am going to talk about, the three ways the U.S. government wants to tax your non-taxed income or gains while you earned when you were U.S. resident, right? So let's get started. First category is your capital asset, such as stocks, real estate, and other, capital asset. So some may have a capital asset that you obtained before you became a U.S. resident. So in that case, you may select to use the fair market value when you became a U.S. resident. Okay. For the capital assets item, there is an exemption. I think 2021 exemption amount was $744,000. So if you have this unrealized gain, you may have unrealized gain, but the government say, okay, for your entire capital, assets item, we will not tax the gains, total gains, up to $744,000. I think this is indexed to inflation, so it goes up. And I'm sure 2022 is a little higher, and maybe 2023 it's a lot higher, which is actually a good thing. There's a little intricacy about how to allocate this gain to more than one capital asset, but I'm not getting into the details. Now, if you are lucky or unlucky, you may have more than this exemptions, taxable capital gain and exit tax. This section is, here, taxable portion. Any gain above in aggregate over 744,000 is taxable when you get out, when you abandon your green card. I said capital gain tax 20%. Some people may have to pay 23.8%, of course, right? But I'm not. The tax rate is not important here. But I want you to understand the basic mechanism of this exit tax on the capital assets item. Okay? Next category, deferred compensation, qualified deferred compensation. Qualified, not taxed. Okay, not taxed. So 401k and other qualified deferred compensation. If you file a form called W8C, you must actually file this on a very timely basis when you give up your green card. But whenever you receive distribution, 30% of your distribution is withheld by the financial institution and send it back to the U.S. government. Okay, and depending on income tax treaties you may have, your home country or your country that you're going to live in, this how you recover some or all of this withholding really depends on your treaty. And if your country that you live in don't have a treaty with the United States, you would probably not be able to recover 30%, but you may also be able to, I think, use a foreign tax credit to reduce your country's income tax. Now, I am talking about too many countries' tax systems, so don't quote me on this one. You got to see each country's specialist or professional to find out exactly how you can get this 30% back. Okay? I am only talking about the US tax rules here. The last segment or last type of the asset is specified tax account, and in other words, it's IRA. And to be precise, the health saving account and Section 529. Unfortunately, for this specified tax account, even if you don't withdraw at the time when you give up your green card, government will tax the entire amount as if you liquidate the entire balance. Actually, to be precise, the day before you give up your green card. So this is, I think this is the most painful tax. IRA, Roth IRA, not too much, but IRA is very, very painful if you have to pay exit tax on it, because they tax you at the ordinary income tax rate for the entire amount. Okay, so just a little bit of recap here. Capital gain tax on the unrealized capital gain over the exemption. Okay. All right. So let's get into a little bit more details here. Capital asset, such as the residence. You still own the residence, right? When you give up your green card, you may have sold the residence. That's not what I'm talking about. Let's assume you have this capital asset anywhere in the world, anywhere. Doesn't have to be in the U.S. Let's say when you give up your green card, fair market value of the house is $2.3 million. Your cost was $1.3 million. So on your unrealized gain, because you haven't sold your house, is $1 million. Exemption is $744. Let's assume that his capital asset is only one, this one. Okay, so 1 million minus 744, taxable portion is $256,000. And depending on the capital gain tax rates, I just, for simplicity, I use 20%. It's $51,200 is your exit tax. 401k, I said you must file WHCE, then you receive a distribution, $30,000 from the US 401k account. 30% of it, $9,000, will be withheld and send it to US government. You're gonna get the $21,000. If you don't file WHCE, it's a disaster, because this qualified deferred compensation will be treated as a specified tax account, which I will explain here. So IRA, I have a IRA $150,000. When I give up my green card, I am a covered expatriate. If you're not covered expatriate, you don't have to worry about the whole thing, okay? Make sure you, please, don't misunderstand me. If you're a covered expatriate, then this will happen. So I have $150,000. Let's say my ordinary income tax rate of the year that I get up with 35%, I have to pay $55,500. Even if I don't distribute, even if I don't liquidate. Well, my government, please, I have still my 401k, I want to keep it, $150,000, but I want to get out. US government say, okay, you can keep it, but I must tax you $52,500. Okay, you must give me $52,000, $52,500. This is how the US exit tax works on a specified tax account, such as IRA, Roth IRA, health saving account, Section 529. Now, Roth IRA, it's a little bit different story, but it's beyond the scope of this video, so I'm not gonna divulge about the Roth IRA. Okay, exemption is for one person, and the tax even not withdrawn. Okay, let's kind of do a little bit more exercise here. What would be taxed? Real estate, stocks. Number one question, are these included in a $2 million test? It's called the net worth test. Answer is yes, it's included. You must include your real estate or stocks anywhere you have in the world. You must count it towards $2 million. Exit tax is capital gain tax. The way they name this tax system is a mark-to-market tax. If you have a cash, and I say U.S. cash, does it get included in the 2 million net worth test? Yes. But exit tax is no tax, because supposedly cash is cash. You pay tax and you get the cash. So unless it's a foreign currency and it has some foreign currency gain and loss, then cash, U.S. cash is U.S. cash. Okay. The Social Security, and this is Japan's public pension. Forgot the exact name. The one is a national pension. The other one is called employee. I'm sorry, I don't remember exact name, but employee-based pension system, employment-based pension system. In Japanese, it's called Kosei Nenkin. Kosei, K-O-S-E-I, Nenkin. Are they included in this $2 million net worth test? No, it's not included because it's not your asset. It feels like these are your asset, but luckily you don't have to include the balance to $2 million test, and of course you don't know the balance, the net present value of this public pension anyway. So if it's not included, no tax. No exit tax, okay? To be precise, no exit tax. Okay, next one is, there's some Japanese writing here, I'm sorry. Joint account, right? Joint account, it's $2 million net worth test is included. Now, how do you split this joint account? Is a very complicated discussion. It depends on your state, where you live in, and depends on other factors. So I'm not gonna get into this. Exit tax, U.S. cash is obviously no tax. That's if you have a joint account in a not Social Security. If you have a joint account in a security account, tax on the capital gain, mark-to-market testing. A Roth IRA, I'm going to talk about. I guess I have to talk about the Roth IRA. $2 million net worth test is, yes, Roth IRA is included. The exit tax is taxable, but most of the time not taxable. So I think I need to explain, because when you get out, let's assume you are already 59 and a half, and also you held Roth IRA more than 5 years. So most of the time, I'm sure there are different, specific exceptions, but let's say I am only talking about the general terms. Even if you take the money out, the beauty of Roth IRA in general, not taxable, and because it's not taxable, exit tax will most of the time will not result in actual taxes. Annuity. There are two types of annuity here. It is mandatory, or you must include your annuity into a $2 million net worth test, because it's, you give most of the time, I think you give cash, you receive a contract from the insurance company that the insurance company promises you to pay you a certain amount. Okay, so it's an asset. Okay, it's an asset and must be included in a $2 million net worth test. There must be a present value of your annuity. If you hold a qualified, not taxed qualified annuity, then 30% withholding will apply. And if you have a non-qualified annuity, capital gain, the net worth, mark to market test will apply. Okay, I think this is the last slide. Yes, it was. Thank you. And this is our disclaimer. And this is a cross-border family practice. I am going to read the few sentences at the bottom. Foreigners residing in the United States with visas or permanent resident of the United States must consider the tax system of both their home country and the United States. Reporting on overseas financial assets, inheritance, gifts, departure taxes, exit tax, qualified pensions, abandonment of permanent residency, etc. are complex and require in-depth knowledge. We have a strong sense of mission to become a guidepost for the lives of the cross-border people and families, and work in a very narrow field with a high degree of expertise. Please get in touch with us if you want to learn more from us. So thank you very much for watching this video. This is my second English video. I am sure my pronunciation or sometimes disturbing to some of you. Apologize, but I'm trying. And have a great day. Take care.